We live in interesting times. Equity markets around the world continue to reach new highs. Bond markets, despite all the talk of rising interest rates in the US and the UK and parts of non-Euro Europe, are close to all-time highs. Private equity houses are continuing to raise record amounts of capital. And the variety of political and geopolitical issues we see around the world have not appeared thus far to overly concern markets. The question, therefore, on many investors' lips is when is all of this going to end? I do not claim to have the answer to this question. We at AVI spend most of our time concentrating on the investments we own and making sure that we are meeting and communicating with management of these companies to ensure a profitable return on these investments. To me, the important questions revolve around valuation of our companies rather than the absolute levels of markets. The purpose, therefore, of my presentation today is to provide shareholders with some insight as to how the portfolio is positioned in the current market environment, and in particular, I would like to focus on how we have responded to rising markets and valuations in parts of our investment universe, and to highlight where we see interesting opportunities today. The first two graphs show the performance of British Empire since I took. The first of these graphs shows the performance of British Empire since I took over as sole manager in September 2015, alongside the very long-term performance since 1985, when John Walton, who I'm pleased to see here today, first started managing the trust. The opportunities we see today, as I hope to describe in the coming minutes, are compelling. And we are hopeful as a team that we can continue to deliver such pleasing returns in coming years. Since I took over, I, together with the support and encouragement of the board, made a number of changes to the way we constructed the trust's portfolio. Whilst I made absolutely no changes to the well-established investment philosophy of investing into companies trading at discounts to net asset value, I stamped my mark on the portfolio in three important ways. The first two are highlighted in the graphs that you see on the slide here. Firstly, I was keen for the portfolio to become more concentrated. As an active, benchmark-agnostic investor, we need to make sure that we allocate capital to our best ideas. If a fund holds too many holdings, it becomes hard to distinguish it from the market. Today, 90% of the portfolio is in the top 20 holdings compared to 70% 2 years ago. And I believe there's scope for this concentration to increase even further as we continue to back our best ideas with even greater conviction. The second area of development was the use of gearing. And as you can see on the second slide here, we've taken out two tranches of debt, the first in January 2016 and the second more recently in November of this year, at what appear to be very attractive long-term interest rates. Both of these issues were for terms of 20 years. More importantly, however, has been the fact that since we first took out the debt in January 2016, the gearing has more or less been fully utilized, and this has been an important contributing factor to our outperformance over the last 2 years. The third area of increased focus over the past 2 years has been on shareholder activism and corporate events as a means of unlocking value. And this is a theme that runs through the entire portfolio and across the different types of company that we invest in. And I hope to elaborate on that in the coming slides. Firstly, though, I'd like to start the discussion by highlighting how the portfolio has evolved in terms of its exposure to different types of company over the past few years. Whilst family-controlled holding companies and closed-end funds continue to dominate the strategy, making up almost 80% of total NAV, the most notable shift over the past year, or the past 2 years rather, has been the very substantial increase in exposure to Japanese equities, which now account for approximately 20% of the portfolio, and where we continue to find today very compelling and exciting opportunities. And before I talk in more detail about those Japanese opportunities, I'd like briefly to discuss the other two key areas of the exposure in the trust. Firstly, The first of which is family-controlled holding companies. Our thesis when we look at family-controlled holding companies is that these companies provide exposure to high-quality assets managed by long-term investors who want the same things as we do, long-term performance from high-quality equity assets. And this is a way for us to align our interests with families who are seeking to transfer their wealth to future generations. And what we're trying to do is to access these high-quality characteristics via companies trading at wide discounts to NAV. And the table at the bottom left of this graph highlights the point. Our expectation is that over time, these companies will deliver NAV returns that are greater than those of markets. And in some cases, we will benefit from a narrowing of the discount in addition to that. And that's what you see when you look at the likes of Wendel, Investor, and Pargesa. It's our expectation that the quality of the assets, together with the active ownership of the families, that combines to drive this strong long-term performance. The narrowing that we've seen across this universe that you see on the bottom right hand of this slide seems that we've seen over the last 18 to 24 months seems to be the beginning of the repricing rather than the end of it. Discounts remained stubbornly wide in the years following the financial crisis. That they have started to recover is encouraging, and that we're able to find wider than average discounts even today is quite exciting. When it comes to investing in other closed-end funds, we seek to take a more proactive role in unlocking value. We're often the largest shareholder in these companies, and this allows us to push for policies that could ultimately eliminate or substantially reduce wide discounts. We engage with the boards of all the funds we hold a position in and seek to do so in a constructive manner in order to help generate strong returns for all shareholders. In recent years, the value opportunity within the closed-end fund sector has been amongst private equity funds, listed private equity funds. The table at the bottom left highlights some of the successes we've experienced in this sector. Some, such as AP Alternative, have achieved very impressive returns, and we've exited this investment at a discount very close to zero, having initially invested a wider than 40% discount. Others, such as JPEL, are being run off so that cash is returned as and when assets are sold. This year, however, as valuations amongst the listed private equity funds have risen in NAV terms and tightened in terms of discounts, we have found other areas of interest within the investment trust space. One example is Pershing Square, which has been a disappointing investment for investors who invested at launch a couple of years ago. We've been buying it in recent months on weakness and on very wide discounts. Which now leads me to the third area of exposure, Japan. Japan has long been a market that has challenged global investors. And over the years following the bursting of the Japanese bubble in 1989, there have been many false dawns. However, from a fundamental investment perspective, we see two very attractive features in Japanese equities today. The first is valuations, or low valuations. Valuation metrics in terms of earnings multiples that are hard, if not impossible, to find in any other developed market. Clearly, as investors focused on companies trading at discounts to net asset value, we're only interested in certain types of company. And what we have identified is a group of companies that have balance sheets laden with cash and that also have good operating businesses that we can access on very attractive valuations. This has allowed us to build a sub-portfolio of some 19 companies, making up an aggregate just under 10% of NAV, which we initiated this basket back in June of this year, and as you can see at the top of the slide, has delivered very impressive returns over the past 6 months. The question, of course, when one looks at these Japanese equities and one looks at the cash on the balance sheet, is will we ever be able to get our hands on that cash? And if not, then perhaps we're not buying into these businesses on such an attractive or appealing multiple after all. And this is where the second attractive feature of Japan comes into play, and that is corporate governance. What we've observed over the last few years in Japan is a marked shift from companies in their attitudes towards corporate governance, shareholder returns, and shareholder activism, all of which has changed at a slow pace, but for the better. As this mindset continues to become more and more entrenched into the corporate psyche, we expect that companies will have to do more to improve capital efficiency, returns on equity, and shareholder returns. This sub-portfolio will be a major beneficiary of this trend, as the companies in it are amongst the world's worst culprits when it comes to capital inefficiency. We're also playing this theme in a more direct manner by taking larger direct positions in companies where we can engage more proactively with boards of those companies. And in the last few months, we've launched a public campaign against a company called Tokyo Broadcasting Corporation, which I will tell you a little bit more about in coming slides. So as I've said earlier, this theme of shareholder activism pervades everything we do in the portfolio. It's fine to buy companies trading at discounts to net asset value, but ultimately we want those discounts to narrow or to disappear. And one of the big drivers of that narrowing of the discount is corporate activism and corporate events. And that is at the heart of the philosophy. Even when we invest in companies that are controlled by others, such as the family-controlled holding companies, we're looking to them to become the active shareholders, to become the active owners of their portfolio companies and to drive returns. And of course, where we can be the largest shareholder and can be the activist, we will seek to do so. So I want to highlight 3 companies from the 3 different areas of the portfolio that illustrate this point. Tokyo Broadcasting and Exor were both positions that were initiated during this year. Tokyo Broadcasting has increased in share price by 48% since we first bought it, Exor by some 30%. And each of these examples highlights how we go about thinking about valuations in the current market environment and how we see value being unlocked in the coming months. In the case of Tokyo Broadcasting, this is a television production company with a market cap of £3.5 billion. Remarkably, its core operating business, that of attracting advertising revenue and developing television content, makes up only 16% of its total market capitalization. It's worth only £600 million. An investor in TBS, therefore, today is not really getting exposure to the television production business. Rather, they are buying a massively overcapitalized company with assets ranging from cash to real estate to a portfolio of Japanese equities. The numbers underscore the point that Japan is home to companies with remarkable valuation metrics. In the case of TBS, 30% of the market cap is represented by income-generating real estate assets in central Tokyo, some £1 billion. In addition to that, 14%, just over £500 million, is sitting in net cash. And the most remarkable attribute here is that some 80% of the market cap is represented by a diversified Japanese equities portfolio or a cross-shareholding portfolio, which is just sitting on the balance sheet. Management, in this case, like many in Japan, are unlikely to change their attitudes towards this balance sheet mismanagement without any prodding from shareholders. And AVI has launched a campaign in the press in recent weeks to pressure TBS to reduce the size of their equity portfolio and to return spare cash to shareholders. We're communicating with management, we're meeting with them on a regular basis, and will continue to push them to adopt higher standards of balance sheet management and corporate governance. The second company I want to talk about is Exor, the Italian holding company controlled by the Agnelli family, who made their wealth out of the Fiat car company many years ago. Today, it's a radically different company. The family control 54% of the shares, and it's run by the great-great-grandson of the founder. His name's John Elkann. And He's massively streamlined the portfolio in the past couple of years. He's taken Fiat, he's merged it with Chrysler, he's spun out Ferrari and CNH from Fiat. Ferrari's share price has more than doubled in the 18 months since it's been IPO'd. And the reason we like it so much is, in addition to the 35% discount at which it trades today, we see a number of compelling corporate events to occur at the underlying portfolio. Specifically, Sergio Marchionne, who's running Fiat Chrysler, is keen, he's been explicit about unlocking the discount at which the company trades to its sum of the parts. It has a number of different businesses that can be spun out in the coming year in the same way that Ferrari and CNH were spun out in 2016. This year, we expect Magneti Marelli, a global components business, to be sold or IPO'd. Possibly in the next 18 months, Maserati and Alfa Romeo could be spun out, could be separately listed. And all of this is active ownership designed to unlock value. And we see an enormous amount of upside potential in the share price of Fiat Chrysler, which will accrue to us as shareholders in Exor, and should also see a material narrowing of the discount as that occurs. And finally, there's JPEL, a good example about how we go about investing in listed private equity funds and closed-end funds in general. We're a large, substantial shareholder in this company. We were actively involved in discussions with the board about the structure of the runoff back in 2016. Since then, they've sold a number of assets and have been returning cash to shareholders. In fact, we're due to receive some 17% of the company's NAV in cash this week, adding to the 21% already returned over the last 2 years. And as it's trading on a near 18% discount, that return of capital at NAV should naturally translate to very attractive prospective returns from here on. These three examples from the three core areas of the portfolio demonstrate the type of opportunity we're seeing currently. Companies that are either doing something to unlock discounts or where there is a reasonable prospect of us being able to encourage them to do so. In all cases, we're mindful of valuations and have rotated the portfolio away from companies we felt were too overvalued in favor of companies that have some valuation support. And the Japanese portfolio example is a clear illustration of this. When you look at the portfolio today, you see that the weighted average discount remains wide at 25%. Whilst this is narrower than the 32% we saw a couple of years ago, or the 35-36% we saw in the crisis years of 2009 and 2011, it remains a lot wider than the 10% we saw back in 2006. And when we look at the activity going on in our portfolio companies, a small part of which I've described to you today, and the prospect of not only NAV growth, but of also discount contraction, the discount levels we observe today seem far too wide and make us feel very positive about the prospects for our company in the coming months. Thank you very much.